What's the outlook for Australian property in 2023? There are so many mixed messages in the media at the moment. So if you're a home buyer or investor, you're probably wondering, should you buy, should you sell, should you just wait to see what transpires? Now, if you've been listening to my podcast, you'll know I believe 2023 is going to be a year when our property markets are going to reset, when a new cycle will begin. But what if I'm wrong? Well, today I'd like to share with you 11 rules for successful property investing that I've seen hold true through the 5 decades I've been involved in real estate. Now, if you're a regular listener to my podcast, you know I usually have a guest on my show, but today I'd like to have a chat, just me and you, because I want to make sure I cover these key principles that successful real estate investors have used to navigate the different markets, the different conditions, and they've used them to come out on top. Now, whether you're just starting out or a seasoned pro, these rules will help you make smart investment decisions and they'll help you achieve your financial goals. Whether the market's hot, whether it's cold, you see, these principles will hold true over the long term and help you become a successful real estate investor. So, welcome to this show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, we're well into 2023 now, and I'd first of all like to start by looking back over the last year or so, because a lot has happened in our property markets, hasn't it? And then, as I said, I'm going to share with you 11 timeless principles. But if we look at what happened over the last 12 months, well, the property boom of 2020-21 ended, didn't it? Now, this time last year, the Melbourne and Sydney markets started to fall already, but the rest of Australia and most of regional Australia, the other capital cities, were all performing strongly, really, till the middle of 2022. But when you look back at what happened the year before that, during that once-in-a-generation boom that's going to go down in history, it's going to be long remembered, homeowners and property investors enjoyed that once-in-a-generation boom. That's a long way off before we have another one of those. But at that pace, that was unsustainable. I mean, if you think about it, just go back and remember the headlines, and we talked about it often on this podcast, armed with record low interest rates and a massive dose of FOMO, fear of missing out. Australians fueled property prices during that boom that weren't seen since the likes of, well, ever. But then, as I said, in early 2022, Melbourne and Sydney property markets peaked and they started falling. That was even before interest rates started to rise, and even actually before inflation reared its ugly head. It really was affordability that was creating the issue then. But then with each interest rate rise, and the Reserve Bank handed down a double whammy, didn't it? Double hikes of 0.5% in June, July, August, September last year. Potential buyers watched their borrowing capacity fall. And that, of course, brought out the property pessimists and the usual band of naysayers warning us of a severe property market correction. And then we were joined by many of the bank economists who similarly forecast double-digit property price falls. Well, we know our property markets faltered last year, and they entered the downturn phase of the cycle because that's what happens. Cycles cycle. But the property markets didn't crash like many of the property pessimists predicted. It depends whose statistics you follow, but the Australian property market, we know there isn't one, according to Dr. Andrew Wilson, fell 4.1%. CoreLogic suggested the overall Australian property market fell just over 5%, and PropTrack, owned by realestate.com, suggested it was less than 3% overall fall. Now, there were definitely certain markets where there was strong double-digit falls, especially the upper end of the markets in our big capital cities, and in particular in Melbourne and Sydney. But other areas actually ended up the year, other than Melbourne and Sydney, they ended up the year with property prices, median prices, higher than the beginning of 2022. Now, I believe this year, 2023, is going to be a reset. Our markets are going to pick up again once inflation is understood to be under control, once there are no more interest rate rises. I can't see a boom any time around the corner, or not just yet. So what I want to share with you today are fundamentals that successful investors have used at all stages of the property cycle. Now, sure, you've probably heard some of these before. I've mentioned them in different ways over the last 4 or 5 years in this podcast. So for beginners, there's going to be lots of new information. And if you're a more experienced investor, please use my chat with you today as a way to make sure you're making the most of the knowledge you have in the current cycle, and it may just bring some nuances, some different ways of looking at things. You see, I see 2023 is going to be a watershed year for property. Yes, there are still many economic headwinds that we're going to encounter, and that's one of the reasons we're getting the mixed messages in the media, because there is uncertainty. But our economy and our job markets are going to falter a bit, but still be pretty strong. But what is certain in these times of uncertainty is that some property investors are going to grow their wealth by taking advantage of the opportunities the markets are presenting them now. Now, many Australians are going to sit on the sidelines waiting for somebody to ring the bell heralding the property market's bottomed, but that's going to occur because savvy investors are out there now looking for and buying opportunities created by the current market. So back to what I said a moment ago, let's look at 11 time-tested rules that the successful investors are going to use to make their fortunes. And the first one is they take a long-term perspective. It's well documented that delayed gratification leads to a better financial position and a better lifestyle in general. Warren Buffett put it well when he said, wealth is the transfer of money from the impatient to the patient. Nothing new about this. Property investing's always been a long-term game. And the longer your time frame and the better the quality of asset you own, the less important it is timing the market. Because whether you make a little bit more or less now because you bought a bargain, that's a one-off hit, as opposed to if you buy the property that's going to grow above average with regard to capital growth and rental return, that compounds year after year. The next rule that successful property investors have used over the decades I've been investing and helping investors was that they invest. They don't speculate. Now, even though they think they're investing, many property investors are actually speculating. The problem is they don't recognise this. You see, all investments come with an element of risk, but in my mind it's important to minimise your risks as an investor. Yet the average investor buys their property emotionally, often near where they live, where they want to holiday, where they want to retire, and then they hope the market's going to appreciate. Others look for the next hotspot. They're out there again at the moment. The reports that I get in my inbox, and I guess you do as well, about which property markets are going to outperform in the short term. There's no doubt there will be some. But that's not what you're looking for. You're looking for properties in locations that are going to outperform in the long term. So these type of investors, they're dependent on outside market conditions to produce a profit. Smart investors do it differently. They make educated investment decisions based on research, based on evidence, based on fundamentals. They buy below intrinsic value in an area that's always, over the long term, had above average capital growth. Sure, there's going to be periods in every area, every location, every city, every suburb where there's periods of no growth. So we look at long-term growth. And at Metropole, our research department has information going back as long as the Australian Bureau of Statistics is offering it. We buy a lot of research and then we put it all together and we analyse it. And so we know what's happened in every suburb, in every state, going back over 45 years. So you've got to see what's happened in the long term, areas that have outperformed the long term. But also one has to look in the future. So we're looking at areas that are demographically more affluent. We're looking for people where people have got above average incomes and income growth for tenants and for owner-occupiers. And we're looking for areas that are gentrifying, where owner-occupiers are renovating their properties, thereby even manufacturing extra capital growth. They're the locations that are going to outperform the averages. Okay, back to the rules. That was the second one. The third one is it's about property. Wise investors never forget the age-old adage that buying the best property they can afford to buy in proven locations. They don't allow themselves to get sidetracked by glamorous finance or tax strategies. On the other hand, those investors who are lured by rental guarantees, tax incentives, speculative off-the-plan, one-off profits, they're likely to miss out in the medium to long term. You see, Rule 4 is successful investors understand that property is a high growth, relatively low yield investment. Now, the argument about capital growth and cash flow has raged since I've been investing over 5 decades. But sophisticated investors know the only way to eventually become financially free using property is to build a substantial asset base. Well, actually not just using property, using any investment class. Now, sure, cash flow is necessary. I understand that. It helps pay the mortgage, it keeps you in the game, but it's capital growth. In other words, having a substantial asset base, that's the only way out of the rat race. Now, savvy investors recognise there are 3 stages to your investment journey, so you need different types of property at different stages. Well, I guess the 4th stage is even the first stage in many ways, is the stage of education. You've got to educate yourself, invest in your education. Then, as you invest, there's the asset growth stage. That's why you need to own properties that grow at wealth-producing rates of return. You've got to build a substantial asset base. Now, I remember recently somebody discussing with me on Facebook, asking some questions. Well, why can't I just buy in regional Australia? I know that the growth is not going to be as strong as the big capital cities, but the returns are good and the properties are cheaper. And the answer is 1 or 2% extra capital growth is going to make such a big difference in how quickly, how safely you grow your asset base. He was comparing regional Australia to Melbourne or Sydney or Brisbane. There isn't one Sydney or Melbourne, Brisbane market, so it's not fair to compare a town of 50, 100, 200,000 people to a city of 5 million people. So yes, the regional Australia is certain cities are going to outperform suburbs in our big capital cities. No argument about it. But we're not buying those in those suburbs. I'm recommending, as I've already said, you buy in areas and locations that outperform the averages. So back to the stages. I got sidetracked there. But there's the first stage of asset growth. Then there's the transition stage once you've built a big asset base, and that takes at least 15, sometimes 20 years, a couple of property cycles. Then you can transition into the stage where you slowly lower your loan-to-asset ratio, and then you eventually move into the third stage where you start living off your property portfolio, off an asset base of sound investment-grade properties that you built over the years. Now, you heard in my previous podcast that I don't believe you should only invest in property. You need cash flow investments as well, so your superannuation, a share portfolio, maybe commercial properties at the right stage of the cycle are all part of the asset base that you need. And to understand how many of them, how much, I guess we need to do numbers and figures. I don't know your circumstances, so I can't tell you now, but that's what we do when we sit down with our clients at Metropole and build them a personalised, customised strategic property plan, tell them exactly what they need. The 5th rule that successful property investors understand is that land appreciates, so they buy properties with a high land-to-asset ratio. Now, that doesn't necessarily mean you buy a large block of land, but one where the land component makes up a significant part of the asset base. And while it's true that land appreciates in value, it's not really as simple as that. Not all land's made equal, and not all land appreciates at the same rate. There are lots of areas where there's ample supply, like in the outer suburbs of our cities, but much of the demand comes from a small segment of the market, particularly first-home buyers. So you've got ample supply and restricted demand. This keeps a lid on capital growth and makes these areas poor investment prospects. Even worse, the land component, the bit that appreciates, usually makes up less than half the total value of the property. In other words, they have a low land-to-asset ratio. However, in the inner suburbs of our capital cities, the proportion of the land value to the total property price is usually considerably higher. Now, again, this is much the same in regional Australia, where the land isn't as valuable, but it still costs the same to build a house out there, often more. So remember, it's the scarcity of the land that causes property values in these locations to keep rising. And currently, you're looking for locations where there's a strong demand from a wide range of owner-occupiers. And that's why I like looking in the inner suburbs where you've got people at all different stages of their life wanting to live there. Now, this trend is likely to continue as more of us start to choose space for place. Again, during COVID, we left the inner suburbs, we left the apartments, but things have gone back to the old trend now, trading space for place to live close to where the action is and the amenity in those 20-minute neighbourhoods, in locations that offer better facilities, better access to infrastructure like public transport, shopping and entertainment facilities. As demand looks set to outstrip the supply in the middle ring suburbs of our capital cities, for many years to come, these areas are where successful investors are going to buy for long-term capital growth. In the next years, where inflation is still going to remain high, which I believe it's peaked, but it's going to still remain high for a couple of years before it falls back to the 2 to 3% range the Reserve Bank wants, and where wages are not keeping up with inflation, you need to find areas where people's disposable income is higher and increasing and higher than average, where they can afford to buy. And that's why I believe our markets are going to be more fragmented, where tenants and owner-occupiers in the blue-collar areas, in the outer suburbs, in the cheaper suburbs, and in regional Australia just are not going to be able to afford to pay more for their properties. So it's important to buy where the land value is high. Now, what about apartments? Well, apartments actually have a land component. I'd rather own an apartment overlooking Bondi Beach or being close to the capital city hubs or great lifestyle locations. I'd like to own a tenth of a block of land in one of those apartment blocks than 10 acres in Alice Springs or other regional locations. Okay, the sixth rule is buy properties that will be in continuous strong demand. You see, not every property in a given suburb is going to make a good investment or have similar capital growth. Savvy investors understand that investment-grade properties are the type that will appeal to a wide range of owner-occupiers, since they make up the majority of buyers. Now, again, you don't want to sell the property, but you want other buyers to buy similar properties to yours, pushing up the value of your property. And that's why smart investors avoid studio apartments, student accommodation, holiday accommodation, serviced apartments. After all, it's owner-occupiers, not tenants or investor demand, that push up property values in the long term. Investors make up 30-ish% of our housing markets. So you want to buy in areas where owner-occupiers want to, can afford to, and are prepared to pay to push up property values. This is going to be particularly important over the next few years, as the percentage of investors in the market seems to be on the lower side. Now, the seventh rule is something you hear me talk about over and over again in this podcast, especially in my regular chats with Simon Kirstenmacher, because I believe demographics holds the key. Over the long term, demographics, how many of us there are, how we live, where we want to live, what we can afford to live in, that's going to be much more important in shaping our property markets than the short-term ups and downs of interest rates, consumer confidence, government meddling. Today, there are more one and two people households. We're getting married later, divorcing more often, living longer. So there are smaller households. So apartments are going to be a preferred style of accommodation, as will be townhouses. And many migrants coming to Australia, and boy, are they going to prop up the property market. They're happy to live in apartments because that's the lifestyle they're used to. This means more of us are going to look for secure medium density. I'm not talking about high density apartment complexes, medium density apartments, family friendly apartments. And I believe townhouses in particular are going to become the preferred style of accommodation as we swap our backyards for balconies and courtyards. So townhouses are big, modern accommodation, but on compact blocks. The next rule I'd like to share with you is that successful investors surround themselves with a great team. You've heard me say it before. If you're the smartest person in your team, you're in trouble. Successful investors surround themselves with a top team of consultants, and they know how to discern an advisor from somebody who's a salesperson. They're looking for somebody who's independent. Now, at Metropole, we have a range of advice, from wealth advice from Ken Race and his team to strategic property plans to property management and renovation advice, but we don't sell properties. And we're not bound by a particular capital city. So if you come and ask our advice, it makes no difference to the strategic property plan that we're going to put to you, help you build. It makes no difference whether you buy in Melbourne, Sydney or Brisbane. We have no stock to sell you. I actually found it reasonably interesting just a couple of days ago. somebody in the industry said to me, I was speaking to a buyer's agent who's done really well last year. He sold 100 apartments in one great big complex. He did really, really well. And I said, well, he's not a buyer's agent, is he? Is it possible that all those clients of his needed exactly the same sort of investment in the same location? Oh, by the way, what sort of investment property is it going to be, this big high-rise block that is totally owned by investors and not owner-occupiers? Interestingly, this person was a mortgage broker, and he, I believe, was a very good mortgage broker, but his advice with regard to property wasn't independent. So I know successful investors are prepared to pay for advice, recognising that if the advice they receive is free, they are likely to be the product rather than the client. The ninth rule of investing is that property investing is a game of finance with some houses thrown in the middle. Those investors who are going to flourish in the next couple of years are going to have set themselves up with financial buffers to cover the rainy day issues, whether it's rising interest rates or other concerns. They're going to have lines of credit or offset accounts to help them ride the property cycle. So as we build a strategic property plan for our clients at Metropole, one of the components of the plan is a finance plan. And what we do is help our clients buy time, not just properties, so that they've been able to ride the ups and downs of the last couple of years of the property cycle without any issues. The 10th rule I'd like to share with you is that successful investors understand where the risk really lies. Most investors believe that there's a direct relationship between risk and reward. The higher the reward, the more the risk there must be. But I found that that's not really true. While most investors think the risk lies in the property or the markets or factors outside their control, in my mind, the biggest investment risk lies with the investor, their knowledge, their experience, and particularly their mindset. So the best defense is to get a good offense. Wise investors educate themselves and they develop a level of financial fluency to make sure their investment journey is as safe as houses. Now, interestingly, most successful investors don't diversify. They specialize. They become good at one thing, an expert in an area or a niche, thereby getting great results. Now, I'm not suggesting that you shouldn't diversify to a degree, but not wildly. So I have a very, very substantial property portfolio, but in Melbourne, for example, it's in 4 municipalities. These are areas that are suburbs that are going to outperform and have outperformed in the long term. Why would I look for a diversification in a different area when these work particularly well? Sure, I've got commercial properties, residential properties, industrial, warehouse, offices, retail, and I've got properties in other states. But again, I'm concentrating in areas that I'm an expert in. The last lesson I'd like to share with you is that the property market moves in cycles. Now, boy, you found that out over the last year or two, haven't you? But during a boom, everyone's optimistic and expects the good times to last forever. Just like we lose our confidence during a downturn, and boy, didn't that happen last year. Truth is, our property markets behave cyclically, and each boom sets us up for the next downturn, just as each downturn, as we've been currently experiencing, paves the way for the next boom, just as it's doing right now. Now, that's something to think about. And I guess a last bonus lesson I'd like to throw in is that smart investors plan. You need to plan. So while the property markets are going to create some significant wealth opportunities for many Australians, statistics show that 50% of those who buy an investment property sell up in the first 5 years. And I really don't see that being different moving forward. And of course, those who stay in the game, 92% never get past their first or second property. And that's because attaining wealth doesn't just happen. It's a result of a well-executed plan. Now, the Australian Taxation Office each year releases statistics of how many properties investors there are and how many properties they own. And there's just over 2 million property investors in Australia, and about 1% of them own 6 or more properties. Now, again, it's not how many properties you've got, because I've seen lots of people with multiple properties, but duds. But if you look at just that one statistic, that 21,000 own 6 or more properties, an audit of our clients at Metropole a couple of years ago, the audit of their results, showed that they're 7.3 times more likely to own 6 or more properties than the average Australian property investor. And that's because they plan. That's because we buy the right sort of properties. So planning is bringing your future into the present so you can do something about it right now. Just to make things clear, buying an investment property is not a strategy. It's not a plan. Just like researching, people get that wrong. Searching for a property isn't researching. So it's important to start with the end game in mind and understand what you need and what you want to achieve. And then you've got to build a plan, a strategy to get there. You see, the property you eventually buy will be the physical manifestation of a whole lot of decisions you're going to make. And they've got to be made in the right order. And as I said, that's because property investment is a process. It's not just an event. So if you're a beginner looking for a time-tested property investment strategy, or you're an established investor, maybe you're stuck, maybe you're just not sure what to do, or maybe you just want an objective second opinion about your situation, I suggest you allow my team, the team at Metropole, to build you a personalised, customised strategic property plan. When you've got a strategic property plan, you're much more likely to achieve the financial freedom you desire. That's proven, because we define your financial goals. You see if your goals are realistic, especially for your timeline. We measure your progress towards your goals. We find ways of maximising your wealth through property, identify risks you haven't thought of. But the real benefit is you're able to grow your wealth through property faster but safer than the average investor. So if you're interested to understand about this, go to metropole.com.au and discuss your options with us. I'll leave you a link in the show notes about our strategic property plan. Because the plan is more than just some numbers and figures. There's an asset accumulation strategy, a manufacturing capital growth strategy, a rental growth strategy, an asset protection and tax minimisation strategy, a finance strategy like I discussed, including a long-term debt reduction, a living off your property portfolio strategy. So it's important to, in this particular stage of the cycle, where the market is not going to do the heavy lifting, that you make strategic investment decisions. Now, I hope the 11 rules of successful property investing I just shared with you are going to help you get more clarity and direction. Why not learn from those who've been successful before? In a moment, I'm going to share my mindset message with you. But if you got some benefit from this and you don't already subscribe to this podcast, please subscribe or follow. It depends which app you use that mentions those words, because twice a week we give you regular information about money, property and success. Now, this was a monologue where I spoke with you. I hope you didn't get too bored with just Michael here, but usually I have some regular smart guests that help you understand what's happening with the property markets and help you succeed. So after that long talk, let's get on with my mindset message.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today I'd like to tell you a story about big rocks. And no, it's not a geology lesson. It's a lesson about time management, about success, about achieving the priorities in your life. And I'm going to tell you a story that you may have heard, but please keep listening, because I'm then going to explain to you what I'm doing personally. You see, a lot of people say, Michael, you're very successful. How do you do that? Others say, Michael, you get so much done. How are you so productive? I'm going to share that with you. Now, I'm not telling you I'm so great. I'm just explaining to you what I've done to achieve what I want in my life, and maybe you'll get some ideas from it as well. So my question to you is, what are the big rocks in your life? Put simply, your big rocks are your priorities. They're the tasks, the projects, or the goals you absolutely must accomplish. If you're like most people, you're going to be very busy. But how productive are you? Successful people always find a way to focus on what's most important, while the average person tends to run into one of three problems. The first problem that stops them being most productive is they have too many priorities. Think about it. If you've got 30 priorities, 30 things that are all important to you, if everything's important to you, you really have got no priorities, do you? The second thing that stops a lot of people is they don't or can't differentiate the truly important priorities in their life. And the third thing I found that stops many people is, for a number of reasons, they let other less important things get in the way of focusing on what's really important, what really matters. Now, setting your priorities, your big rocks, can be hard. We've all got different priorities. But before I'm going to go into how you can organise them, let me tell you a story about big rocks. It goes like this. One day a teacher was speaking to a group of students. She pulled out a large jar and put it on the table, and then she produced about a dozen big rocks and placed them one at a time into the jar. When the jar was filled to the top and no more rocks would fit in, she asked, "Is the jar full?" And everyone said, "Yes." "Really?" asked the teacher. "Let's see." Then she took out some gravel and dumped the gravel in. She shook the jar, causing it to fall between the spaces between the big rocks. She asked the students again, "Is the jar full?" Her class was catching on. "Probably not," said one of them. "Very good," she replied. And then she brought out a bucket of sand and dumped the sand in, and it went in all the spaces between the rocks and the gravel. Then she asked, "Is the jar full?" Well, the class caught on by then and they said, "No." "Excellent," she replied. Then she grabbed a jug of water and poured it in until the jar was filled to the brim. And then the teacher looked intently back at the students and asked, "Well, what's the point of this illustration?" And one student said, "You can always fit more things into your life if you really work at it." And the teacher said, well, that's true, but that's not really the point of this illustration. She said, this teaches you that if you don't put the big rocks in first, you'll never get them in the jar. So she asked her students, what are the big rocks in your life? She asked them, is it time with your loved ones? Is it your faith, your education, your dreams? Is it your career, a worthy cause, teaching or mentoring others? And then she concluded her lesson to these university students by repeating the important message. Remember, these big rocks go in first, otherwise you'll never get them in. So what does all this mean for you? Well, your big rocks are the things on your bucket list, your non-negotiable goals, your dreams, your true desires, things that you can do to make your business or your life or your employment or your investments more successful, things that fulfill you, things you can do to make you healthier and happier. Your pebbles, they're things that you love to do or need to do, but aren't crucial to your happiness or your success or your fulfillment. I don't know, maybe projects around your house, maybe it's watching your favourite football team, maybe it's mahjong lessons or bridge lessons. They're the pebbles in your life. The sand is the mundane day-to-day tasks in your life. It could be checking emails, walking the dog, paying bills, grocery shopping. I don't know what's it for you. And the jar, that's your life, your time, your energy, your budget, your resources. By the way, you only get one jar. Now, these are all different for everyone. One person's big rock may be another person's sand. I mentioned a moment ago that for some people, the sand is going to be, or the pebbles could well be, walking a dog. I know for both my boys who've got dogs in an important part of their families, walking the dogs would be a rock. They actually spend time with them. Anyway, I'll go through in a moment how I handle this, but what I was getting at was one person's big rocks, maybe another person's sand. So make sure you've got your big rocks in your calendar or your to-do list as not only urgent, but important items. Otherwise, you're going to get sidetracked. Most people get distracted by other people's priorities, things that seem urgent, but aren't necessarily important. In big rocks, they fill their jar with lots of pebbles and sand, but no big rocks. None at all. Remember, I said you only get one jar. You don't have unlimited time. You don't have endless money. You don't have untold resources or energy to do whatever you want. You can't fit everything that you'd like to fit into your jar. So put the big rocks in first, then your pebbles, then your sand. This way you've prioritized your big rocks and you're going to complete those before you move on to what may seem important, may seem urgent, but actually is less important. Now, let me explain to you how I put this concept into action. It may give you some clues. First of all, I made a list of my big rocks, 6 of them, my pebbles, 10 of them, and my sand. So I asked myself, what's on my bucket list? What are my non-negotiables in life? What's the highest and best use of my time and my business? So the first thing, I made a list of my big rocks. And the second thing I did was I put my big rocks into my calendar first, before somebody else grabbed the time. Then I started filling in the time with pebbles and sand. So my holiday times away with Pam for next year are already blocked out. Now, I don't know exactly where I'm going to go with COVID, but that doesn't matter. The concept is that the time is there and that won't change. The times I set aside each week for visiting my children and grandchildren are blocked out in my calendar for a whole year in advance. They can't be moved. No other appointment with clients or anything that's going to make me money is not anywhere near as important as my time with my children and my grandchildren. That's a big rock that doesn't move. My afternoon walks along the beach, they're blocked out. There's no room to do anything else at that time of the day. And my highest and best business tasks, like writing and recording my podcast, they're locked into my calendar. Now, I've left some space for incoming and last-minute pebbles and sand. I've learned that what gets scheduled gets done, and what doesn't get scheduled often doesn't get done. So I made a list, then I put them in my calendar. So I've scheduled my big rocks in the morning, interestingly. You see, I know when I'm most efficient, and that's first thing in the morning. And actually last thing in the afternoon. I'm not as efficient or creative in the middle of the day. But we're all different, aren't we? I've also learned the principle of getting important things done first in the morning. So then when I've got them done, I can actually get on with other things because things crop up every day. So I've learned to ask myself, is this a big rock? When I need to decide how best to spend my time, my energy, my money, I always ask myself this important question. Is this a big rock? If it is, I make sure I find the time to put it in the jar. Now, this concept is so simple, yet it's profound. Now, I learned it from Stephen Covey, author of 7 Habits of Highly Effective People, who taught me the difference between being busy and being productive. It's not about getting more stuff done. It's about getting the most important things done. So my question to you is, what are the big rocks in your life, in your career, in your relationship, in your wealth, in your health? And for each of these big rocks, are they in place? Have you put them into your jar first? If not, are you working on getting them in place, or have you neglected them? If you don't consciously work on your big rocks, you're never going to get them in place. So I hope that explaining this to you has helped you understand how to get your priorities in the right order to make sure that they get done. It's been a slightly longer message today, a longer mindset message. Doesn't matter. It's such an important message. I thought it was worth spending the time teaching you the concept of the big rocks in your life. Now it's up to you to take action and implement the lesson I've taught you. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?